As you can see, though, the drawdown now is in its 52nd month, down a record-breaking 17.2%, which, of course, both categories shattering records. I want to bring in J.P. Morgan Asset Management, their fixed income portfolio manager, Kelsey Barrow. And Kelsey, what's the story here? I mean, a lot of people try to cherry pick. Well, if you bought these bonds like 3 days ago or 4 hours ago, I mean, overall, August of 2020, it's been a struggle.
Right. So if you take the returns from August of 2020 to today, what you're including is the Fed hiking rates 525 basis points at a record speed, something we haven't seen since the 80s.
Right.
So that's a very deep hole to dig ourselves out of. But if we look at this year, the U.S. Ag has returned 2 to 3%. And that doesn't include the fact that, an active fixed income manager is not just looking at treasuries, they're not just looking at mortgages, they're also looking at corporate credit, emerging market debt loans. U.S. high yield this year is up 9%.
But let me ask you, though, is there a new paradigm? In other words, are we assuming that all those rate hikes are going to eventually be erased and we go back to the good old days when there was that zero?
Well, I don't think the good old days were when we were at zero. So no, I don't think that we're going back to zero, and I don't think we want to be going back to zero.
Right.
Because the way in which fixed income really floundered is when interest rates were so low. The flip side of your chart of the drawdowns over the last few years is that the opposite side of that coin is that yields are significantly higher.
Right.
So you can build a portfolio, a diversified portfolio of high quality and low quality credit that yields about 6 to 8%. Your yield is your best indication of your forward-looking return.
So before we get to some of those specific ideas, the maturity wall. So at the beginning of the year, it was like, oh, the maturity wall. Then, of course, the Fed's going to cut 29 times. I'm being facetious here, but it was not, the maturity wall was going to be gone. Now, this is, by the way, the U.S. Treasury, but we could talk about commercial real estate, which now we see is starting to really show some cracks. We could talk about the housing market, mortgages. I mean, this maturity wall, how does that impact the overall economy? How does that impact the overall financial markets?
So I think we have to differentiate between the finances of the U.S. government, which we know are challenged, and the finances of everybody else. So your household has
small businesses, for instance.
Right. So small businesses, they also have a little bit of trouble in terms of those higher borrowing costs. But I'm thinking more about your investment grade and your high yield corporate companies, right? Those are companies that have actually been preparing their balance sheets, shoring up their balance sheets, extending their maturities. Right. They don't have that maturity wall. And your homeowner, they have a 30-year fixed rate mortgage. Those have effective rates that are actually below 4% right now. But
the housing affordability it's a sidebar to that. All right, let's talk about the fixed income styles, because you've been adamant about, hey, this is where the opportunity is right now.
Yes, so we have been leaning in all year to corporate credit, particularly where you can get an incremental yield above the Treasury. And as we just discussed, the fundamentals for the U.S. government and the amount we're borrowing is a very different picture from the fundamentals in the corporate credit world, where leverage is actually stable, earnings growth is healthy, companies have termed out their debt, and as a result, again, you've seen returns that have outperformed treasuries and outperformed carry.
And just to show the audience, so you have the low here. I mean, the census 78%, moderate 8.6%, limited 9.1. This is a pretty good, and you can sleep at night. This is essentially what you're saying. You're making big money and you can sleep at night.
Right, you're higher up in the capital structure. So why take the volatility of equities where you can get a similar return over a period of time? 9% is what most people assume the average S&P 500 return is going to be over a multi-year period. Right. And you can get that right now in high yield.
All right, I got to go, but quickly, the Fed rate cuts this month, is that still on for you?
We do think that the Fed is going to deliver the 25 basis point rate cut in December, and then they're going to start talking about slowing down that pace of rate cuts going into next year.
Okay, they'll talk about it in this announcement.
Yes.
Okay, good stuff. As usual, appreciate it. Thanks a lot. All right.